Assalamu alaikum, hi dear students. Hope everybody will be fine. So today our topic is types of the financial assets with respect to their nature. So the basic types of the financial assets are financial securities that can be divided into three broad categories, which have some further subparts. But before going to study the types of the financial assets, what is financial assets? So financial assets, as I discussed my previous lectures, that those assets, financial assets, are those assets which is used for generating finance by corporations, like bonds, like shares, like commercial papers, like T-bills, etc. All these are called financial assets. So there are also other many security too, but for this course we are confined them only. So look at financial assets, first divided into three categories: interest bearing or debt security, number 2 equity security, and number 3 derivative securities. Interest bearing or debt securities, for example, bonds, commercial papers, treasury bills, promissory notes, etc. These are words. These are all called interest bearing securities or debt securities. Why? Because fixed interest that are from the side of the issuers, and this is a source of debts financing. That's why this is called debt securities. Debt securities, that is further divided according to their maturity in two types. One, money market instruments or short-term instruments, and second one is fixed income securities or long-term security or capital market securities. Money market instruments or short-term instrument means these are such interest-bearing debt securities which have maturity up to 365 days or less than 365 days. So those securities are called money market securities or short-term securities. Why? Because their maturity is up to 1 year or less than 1 year. Fixed income securities are long-term securities. This is also called capital market securities. So these are such securities which have the maturity more than 1 year. Meaning that their maturity is for the long period of time, maybe 2 years, 1.5 years, 3 years, 4 years. And so on. Second one types, that is called equity security. So equity security means that these are such type of the security in which the corporations offer on percentage of ownership right to the security holders, and in this way they are generating funds. So These type of securities are called equity securities. Equity securities, simplest type is common stock and preferred stock. Common stock is that stock which have unlimited securities, maturities. When companies issue it, so until and unless the companies they are in a running position or in the operational positions, so those common stock will not be redeemable till the closing of the company. Voting rights are given to the common stockholder. Similarly, the the dividend of the common stock, that is not fixed. Sometimes common stockholder get too much dividends when company gets high profit. Sometimes they are not getting the dividends. Sometimes even though the business are in loss, so common stockholder compensate that loss. Right? Now preferred stock. So look at preferred stock. Are those securities which have both the qualities of the common stock and of the debts. That's why these are also called quasi stock. The dividends of these stock are fixed even. Clear? And their maturities are known. They don't have the voting rights and so on. And in preferred stock also ownership rights are given and they are convertible to common stock. So that's why these financial assets are called equity security. Equity means ownership rights. Number third, derivative securities. So derivative securities, as I discussed in my previous lecture in details, that these are those securities where actually the payments in such type of the security not taken place, but these are just only made for the future transactions and whose values are derived from the other underlying assets. So the common example of the derivative securities is futures and options. These futures and options I discussed in my previous lecture in details. So these was the main categorizations of the financial assets, that how are the financial asset and how we can divide it into different types. So hope that you will understand the types of the financial assets with respect to nature. Now our new topic is treasury bill. Treasury bills are, this is also called T-bill. That is a short-term government's debts obligations backed up by the treasury departments with a maturity of 1 or less than 1 year. Treasury bills are usually sold in the denominations of $1,000 by the United States governments. Mostly the treasury bills, they have the maturity period ranging from a few days up to 1 year, or we can say that 52 weeks. Mostly the treasury bills considered among the safest investments, since they are backed up by the full faith and credit of the government. So dear students, when an investors buy a T-bills, so they are lending money to the governments. The government uses the money to fund its debts and pay ongoing expenses such as salaries and the military equipments and so on. T-bill are sold in the denomination ranging from 1000, that is standard, up to a maximum of 500 millions. Treasury bills are sold at discount to the par value. Keep in mind, which is actual value. For example, a T-bills with a par value of 1,000 or 10,000, let's suppose, may be sold out on 9,500. The governments, through the Department of the Treasury, promises to pay the investors the full face value of the T-bill at its specified maturity date. Upon the maturity, the governments will pay the investors 10,000. So resulting is a profit of $50 per T-bills. The amount of profit earned from the payment is considered the interest earned on the T-bills. So the difference between the face value of the T-bills and the amount that an investor pay is called the discount rate, which is calculated as a percentage in case the discount rate is 5% of the face value. So the T-bill rate directly, we can say that that is a 5% discount rated T-bills. Look at, dear students, T-bills only and only that is issued by government, like SBP here, abbreviated it State Bank of Pakistan, but like here in Afghanistan, that is issued by Central Bank of Afghanistan, dubbed the Afghanistan Bank, DAB. Mostly it's sold on the discount. Discount price. One is called discount price, one is called premium price. How it's sold out on the discount? No interest that should be offered here, but the discount price is considered as a returns for the investors. Like, what is discount process? Discount prices is the prices when any security that is sold out less than their face value. For example, if the T-bill face value is 100 and governments they sold out on 90 and promises that they will redeem it, call it back, redemption price is how much? That is 100 face value. So this is called discount price. So mostly T-bills that are issued by the governments. And when they are issued by the government, so they are issuing on the discount price. No interest is offered on T-bills. So discount price is the profit margin of the investors. Clear? Okay. That is sold on the discount and redeemable are at face value. Redeemable means call back. Like, look at the 3 months T-bills that is issued by governments. Their face value is 1000, but government offer you this on 900 and promise that I will redeem it in a call it back after 3 months when their maturity is complete. So I will buy back it on 1000. So getting back or buying back, that is called redeemable. Yeah, call back the security. So mostly the T-bills that is sold out on the discount and call back on the face value. That is sold out through by auction. Maybe the auction may be the competitive bid or for the non-competitive bid. The T-bill mostly that is sold out in the auction. Auction means boli. So competitive bidding auction and non-competitive bidding auctions, here the two words that are given, that when the government that are sold out in it, so either they will conduct a competitive bid or non-competitive bid. What is non-competitive bid? Keep in mind. In a non-competitive bid, the investors agreed to accept the discount rate determined at auctions. The yield that an investor received is equals to the average auction price for the T-bills sold in the auction. Individual investors, they are preferred this method since they are guaranteed to receive the full amount of the bill at the expiry of the maturity period, at the maturity time. The payment is made through Treasury Direct or the investor's bank or broker, through by brokers. So this type of the selling auction is called non-competitive bid. In a price, discount price is fixing by itself by governments and investor accept it. In the competitive bidding auctions, investors buy the T-bills at a specific discount rate that are willing to accept. Even submitted bid, the government's the lowest rate or discount margin that the bidder or investor is willing to accept. Bids accepting the lowest discount rate are accepting first. If there are not enough bids at this level to make the issue fully the subscribed T-bills, so then the bids at the next lowest rate are accepting, and this process is continuous until the entire issued T-bills has been sold out. So purchase payments must be made either through a bank or through a broker. So this was the difference between the competitive and non-competitive bids. Next one property, or we can say that the of the T-bills. So highly liquid and easily transferable. The liquidity of the T-bill is too much high. Any time if the investors want to sold out it in the secondary market, so they can be sold out and can be easily convertible into cash form. Recovering short-term deficits by governments. Look at why government issued the T-bills. So when the government needs budget deficits, when they are facing budget deficits, so for the compensation of that budget deficits, the government issued the T-bills instead of the issuing the currency notes. So then governments compensate the short-term deficits and recall back those T-bills and pay back the money of the investors on the maturity times. So the main purpose of the issuing of it is to compensate the budget deficits. What is budget deficits? Budget deficits means that when the government's public revenue is less than public expenditures. So for the compensating of the public expenditure budgets, they are facing deficiency. So to recover that short-term deficiency, the government issues the T-bills. These T-bills that be purchased by individuals, single person just like me and you peoples, institutions, maybe different institution can also make investment in the T-bills and they can buy it. Corporations, different companies and banks can also purchase. And there is no restriction that anybody who can buy the T-bills, so yes, they can buy it. Profit to investors on the T-bill is the price differences. Look at, as I discussed, that what is the profit margin here for the investors, even though interest is not offered on it. So profit margin is the discount price, that the difference between the discount price and the face value. Like if the T-bills face value is 1000 and that is sold out in the market on 950 or 960. So at the maturity it will be redeemed back on 1000. So 1000 minus 960 is equals to $40. This $40 is the profit margin per T-bills. If you purchase the 1 lakh, so 1 lakh multiplied by 40, that is your profit margin. There are different types of the T-bills based on their maturity. For example, sometimes government issued 3 months T-bills, sometimes they are issuing 6-month T-bills, sometimes 9 months and 12 months. So the types of these T-bills depends upon their maturity time. Next one is yield on the T-bill is based on their appreciations in the price between time of issue and the time that they are mature or sold by investors. In a yield on the T-bills, returns on the T-bills. So here that is what's that is the how they can calculate. So through by the following formula. For example, the par value, let's suppose the par value of the T-bill is 1000. So 1000 minus purchasing price 960 divided by 1000 multiplied by 360. So 360 if the T-bill is of 1 year, so we will write 360. If the T-bill is of the 6 months, so we will write 180. If the T-bill is of the 3 months, so we will write the 90 and so on. So 360 divided by days to maturity. Days to maturity, instead of that we will write, that is, if T-bill is of 3 months, so we will write 360 by 90. If T-bill is of 6 months, so we will write 360 by 180. And in this way we can finding out the returns of the on the T-bills. So hope you will understand this one, that what is T-bills, why T-bill is issuing, who issued this T-bills, and when they are issuing, so what are the weight that T-bills that are issuing by the governments, and mostly how they are working, why they are issuing, how their returns is calculating. There are also some other factors that they are affecting the T-bills, like monetary policy. So the Federal Reserve's monetary policy is likely that they are, dear students, they are affecting the T-bill price. T-bills interest rate tends to move closer to the interest rate set by the governments. They can also says the fund rates. A rise in the federal funds rates tends to attract investments in the other debt securities, resulting in then drop in the T-bills discount rate. And similarly, when the decline is continued, so the T-bill interest rates raises above the federal funds rates. So monetary policy, they are also affecting that discount rate. Similarly, maturity periods of the T-bills, they are also affecting the rate of the discount or returns on the T-bills. So look at, dear student, this is too much simple logic, that the maturity periods of the T-bills affects its price. How? For example, a 1 year T-bill comes with a higher rate of returns than the 3 months T-bills. The explanations for this is that longer maturity means additional risk of the investors. So let's suppose, for example, 1000 T-bill may be sold on 970 for the 3 months T-bills, 950 for a 6 month T-bills, 900. So for the 12-month T-bills. So the investor demand a higher returns. Of the returns compensates them from tying up. When their money for the longer periods they are tying up, so automatically they will also return too much more returns. So these are similarly, inflation is also affecting the T-bills. The price of the T-bills can also be affected by the prevailing rate of the inflations. For example, if the inflation rate stands at 5%, so and the T-bill discount rate is 3%, so it becomes uneconomical to invest in the T-bills, since the real rate of the returns will be in the loss. So the effect of this is that there is less demand for the T-bills and the price will be drops. So hope you will understand the T-bills. So inshallah our upcoming topic is commercial paper, which we will discuss in our upcoming class. For now I will take permissions. Bye bye, Khuda Hafiz.